This week has been an interesting one for the investment management industry, getting stick from no less eminent a personage than Prince Charles, who has accused the investment management industry of a current focus on quarterly capitalism that is unfit for purpose. This week's also seen some other interesting news. Neil Woodford is stepping down from Invesco Perpetual, fund manager with a very outstanding long-term track record, who's been prepared to go against the short-termism of the markets and has long decried the short-termism that is prevalent in the city. And finally, we've had the Nobel Prize Committee for Finance awarding prizes to both Professor Eugene Fama and Professor Shiller for their what seems to be contradictory work on the workings of the markets. And let me explain. Professor Fama came up with the efficient markets theory, which basically states that it is nigh on impossible to outperform the market over the long term. That in fact gave birth to the whole rise of the passive style of investing using index trackers on the basis that that was going to give a better return because of reduced costs than going for the traditional active management route. And then we've had the work also of Professor Shiller, who famously wrote the book Irrational Exuberance and pointed out that markets can behave extremely irrationally. Case in point, the high-tech boom at the end of the 20th century and the following bust, and also the real estate boom and bust in the United States of America. So these two views seem to be contradictory. Before I return to Prince Charles and Neil Woodford, I would point out actually that the concept of index tracking, it is absolutely true that markets will behave irrationally at certain stages, both during a market boom and, for that matter, during a market bust when nobody wants to invest. But I think the point that Professor Fama was making, a bit like Winston Churchill on democracy, Churchill said that democracy is the worst form of government except for all the others that have been tried from time to time. I think Professor Fama would say that index tracking is likewise the worst form of investment except for all the others that have been tried from time to time. But actually looking at it a little bit, opening the bonnet on the efficient markets theory, Professor Fama did show that in fact if one had a tilt towards value companies, value style investing, if one had a tilt towards emerging markets, if one had a tilt towards smaller companies, this would lead to long-term outperformance. So returning to Neil Woodford, what would be really interesting is to actually analyse how much of his long-term outperformance was actually due to his heavier weighting towards value companies and value-style investing. What's for sure is that following that approach means a preparedness to accept periods of sharp and significant underperformance. For example, Neil's fund underperformed the market by 14 percentage points in 1999 and 23 in 2009. So you had to be a real believer to stick with Neil Woodford through those difficult moments. But what I really take from all this, Prince Charles, Neil Woodford, the award of the prize to Eugene Fama and to Professor Shiller, is that our current markets and the way that they work are far too much orientated towards short-term trading. Largely that's a function because of remuneration. The city is tied to year-on-year performance. So fund managers are always scrambling around and overtrading and trying to outperform their index, usually to no avail. But also, as Professor Kay pointed out in his recent review in the City, The short-term horizon is basically introduced by the intermediary sector. Pension trustees are told they should keep reviewing managers, whilst retail investors get constant invitations to trade from independent financial advisors and the platforms set up to enable them to do so. So the entire city and the entire investment management market is geared towards luring people in to trade on the short term. As Professor Kay points out, how easy would it be for somebody like Warren Buffett with an incredibly long-term horizon to set up now? What I take away from all this is the long-term patient investor needs to take a deep breath, avoid short-termism, and the best solution, or the best of all the bad solutions available out there, is to go with an index tracking strategy with a bias or with a tilt towards value investing. Over and out.